Breaking news!
Smart News will present about investment management by Sarah, Farhana, Miriam, Afrina, and Amna.
Welcome to the Invest Smart News, your go-to source for all the investment. I'm Sarah.
And I'm Farhana. Today, we break down the essentials of investment management and explore the concept of risk return and investment objectives.
Let's start with the basic of investment management. It's the process of managing money and assets to achieve financial goals. For instance, money in a saving account generates current income through the periodic interest payment, but investment can also increase in value. This happens when the sale price of an asset exceeds purchase price, adding current income in capital gain, and you will get total return over time.
But investment isn't just about returns, it's also about understanding risk and return.
Exactly, Farhana. So what's risk?
Risk is the possibility of losing some or all of your investment. In return, that's the profit or loss you generate over a certain period. There's a key relationship here. Higher risk often means higher potential returns, but with lower risk, you likely see lower returns.
Let's take a look at different types of investment on how they stack up.
Government bonds, very low risk, potential return 3 to 4%. Fixed deposit, also very low risk, potential return 2 to 4%. Corporate bonds, moderate risk, potential return 4 to 6%. Dividend paying stock, moderate to high risk, potential return 3 to 7% plus stock growth. Equity stock, high risk, potential return 7 to 10% long term. Real estate, high risk but potential return 10 to 15%, combining capital appreciation and rental income. And that brings us to investment objective. Every investor has goals. These typically fall into 3 categories. Capital appreciation, growing the value of your investment over time. Income generation, earning regular income from interest, dividend or rent. Capital preservation, protecting your original investment and minimizing losses. Before we go, remember the world of investment offers a range of opportunities, but no investment comes without risk.
That's right, Farhana. Up next, we dive deeper into the risk factor investors need to consider. For that, let's turn it over to our colleagues, Amna Nabiha and Nur Afrina, who will guide us through the key risks you should be aware of.
The first risk factor is market risk. This occurs due to uncontrollable fluctuation in shares or market value. It can be managed through the timing of share transactions and diversified investments. Next is inflation risk. It refers to the uncertainty in future purchasing power. This risk is managed by investing in assets with return above inflation or inflation-protected instruments and holding the asset until maturity to get the full coupon value. In addition, for interest rate risk, it arises from changes in interest rate that affect the value of bonds. The mechanism is to hold bonds until maturity or invest in short-term bonds that are less sensitive to rate changes. Lastly, the credit risk that occurs when borrowers fail to meet their obligations. How to overcome this risk by reducing it through credit insurance and careful credit analysis to assess the borrower's reliability before granting a loan.
The investment cycle shows how money moves in the economy. It starts with investors providing capital by buying assets like a stock or bonds. Then financial market connect these investors to companies or governments. Issuers like companies raise funds by selling securities to finance their activities. Regulatory bodies ensure fairness and transparency throughout the process. Finally, investors receive returns such as dividend, interest, or capital gains, completing the cycle. In short, the investment cycle drives growth and rewards investors, keeping the economy running. Now we move to another segment of our news, the types of instruments.
So thank you, Amna and Afrina. Now let's dive into types of investment instruments available to investors. So for your information, investment instruments are divided into 2 main categories, which financial assets and non-financial assets. So let's start with financial assets. These are highly liquid and easily traded in formal markets, for example, common stocks where investors own share of a company, bonds, which are fixed income securities offering steady returns, unit trusts, professionally managed funds that hold money from multiple investors, and derivatives like optional warrants, which derive their value from other financial instruments. Now, let's move to non-financial assets, which are tangible and less liquid. These include real estate, like residential, commercial, and industrial properties. Real estate is popular for its potential to hedge against inflation, chattel or movable personal property such as antiques, classic cars, and vintage collectibles. These items are often traded in formal markets and valued based on supply and demand. So each of the instruments caters to different investment goals. Financial assets are ideal for liquidity and income generation, while non-financial assets often focus on long-term growth and wealth preservation. And do not forget, understanding the advantages and risks of each type is key to building a balanced portfolio. For example, financial assets are easier to trade, but non-financial assets can offer unique opportunities for diversification and inflation protection. So that's all from me. I pass back to my Sarah and Farhana.
Thank you, Maria, for breaking that down. It's fascinating how different types of investments serve various financial goals. And that's all for today Invest Smart News. We hope you have gained valuable insight into investment strategies.
Remember, info investing is key to achieving your financial goals.
Thank you for tuning in. Stay smart and invest wisely.
Bye!
Okay.
Government bonds, very low risk, potential return 3 to 4%. Fixed deposit also
Investing in assets with returns above inflation.
Keluar!
Gelap eh.
Pula.
Thank you, Amna and Afina. Now let's
Wait,
kau tengok aku buat apa?
Aku buat apa? 1, 2, 3.